Welcome, and my name is Mike Hamilton. Let's get on with this look at the markets. So what I want to do in this session is I want to look at three basic fundamental economic measures, and then I want to look at the technicals for NASDAQ and the FTSE, and then talk about what I think could be about to happen in these markets this year. So one of the things I'm keeping an eye on is three things: debt, personal debt, money supply, and jobs. So let's take a look at personal debt is climbing. You can see on, let me get my tool. So we flew up in 20, and then we've been tailing off significantly, especially into last year. But this year we're projected to climb, and personal debt levels or credit card debt is, I believe, it's an all-time high at the moment. So I'm surprised this chart isn't showing a greater level of debt. If we just, let's just look at the money supply. M2 is the broader money supply indicator. So basically the sort of velocity of money flowing around the economy. So right all throughout last year in the US, this is all US figures, by the way, money supply has been increasing. So any leveling off, any tip over of that could spell trouble for markets. So far this is all good, unless of course private debt really starts to escalate and money supply rolls over. If we look at jobs, we've got non-farm payroll. Hi. Non-farm payroll on Friday, monthly jobs. Let's have a look at the non-farm payroll levels. Right, so we've seen, we added a lot of jobs on the last number. October was incredibly low. So let's look at 3-year level. Yeah, so at the moment, these are jobs added to the economy. So at the moment we are in positive territory. So we step down here. So you can see 2020, because a series of lower highs here. Came into 24 looking all right and then peeled off. And then into the autumn, we started to see some pushes back up. So again, if we can sustain these levels and break these autumn highs and see a decent level of job creation, then that spells that's good news for the economy. But if this turns out to be another lower high and we can't sustain this growth in job creation, then that is obviously going to spell bad news for the economy. So all the fundamentals at the moment are stacking up for the moment. Now down to the chart. So I've pulled up the NASDAQ, because what the NASDAQ does, the rest of the market tends to follow. So we've already had a couple of lower highs here, and then into the back end of the year, certainly that's the Thursday the 2nd, yeah. Well, hardly anybody's around that day. So here we are on the first Monday, the first full week in 2025, holding right up. But all we're doing is climbing into this decline of late December. So we need to hold this level on the Nasdaq and ultimately break this high. If you look at the weekly, so we've had 2 weeks of lower closes, week beginning 16th and week beginning the 30th of December saw lower closes. So we need to sustain this weekly chart if we are going to get off to a good start. Now, what I would suggest you do is, here's a hot tip. It's always good to isolate the January level, particularly this first week, and mark it off and then see if we can hold it. So if I go back to January last year, so we had a lower start on the very first week and immediately closed higher. This is the second week here. I'll zone the second week. Well, actually, that's the first and the second week of January last year zoned. So what we saw was a drop into support, higher close, and then we continued to move right into March before we finally toppled back into May. But when we did topple back in May, all we did was return to the breakout level on the second week of January. So that's why it's really, really healthy to mark off this initial open in the month and then see if that holds. So let's just take all this off. And what we got at the moment is, let's mark off this low. We'll mark off that December high. So whichever way, so that's not that big a target. It's or it actually is quite. It's about 900 pips on the Nasdaq. So whichever way we come out of this area is potentially going to determine what the market could do, certainly into the first quarter. And if we see a repeat, so if we see a repeat of last year, that would mean the market's breaking the high and potentially going up into March, possibly into May, and then pulling right back to the breakout area, and then the rest of the year grinding higher. That's the bullish scenario. Bearish scenario is we can't break through that all-time high, start to get a lower close, and then ultimately break out of this low. Pen is really slow. All right, let's have a look at. So we've got the 50-day average. There's the 20-day average, and there's a 200. So this is an incredibly bullish chart. We're above all the major moving averages. Let's take everything off apart from the 20. So it would be normal for the markets to return to the 20-day average. So what I'm trying to say is if we see a series of lower highs in this and we do ultimately break down to 20 and a half, any break of that 20 and a half and this market's in serious trouble. All right, let's look at the daily chart. And then let's put on, tell you what, let's range last year's. And we ranged 23 first, and then we ranged last year. Right, so if we had looked at the range of 23, so when we broke when we pulled back on in mid to late April, all we were doing is pulling back to 23 highs. And then we almost went to the extension in mid-July, pulled right back in August, and then broke the extension back end of the year. So let's have a look at, let's range last year's. Right, so this is the 24 range. Let me make sure I got that right. Yeah. So the 2024 range is here. Right, so it will be perfectly healthy to come back to 21,200. 20 and a half was the weekly average. Okay, so if we start to close under 21,200, then hold on to your hats because this is coming down. So anyway, we need to mark off that weekly chart and see if that is sustainable, but perfectly acceptable for a bullish market to come back to these levels here. But any breakdown, you can see there's a channel. I've just drawn a channel. So we created a low of the channel on the second. The high of the channel would take you back into to last year's highs. And if we can break further, so bullish. Next stop, if we're really bullish, 22 and a half on the Nasdaq. And if we really get going, we could see 25. Any breakdown, any close under 21, and particularly 20 and a half, then this is toast. It's had it. FTSE. Terribly lost my FTSE. Where's it gone? Yeah. Come Right, so the FTSE has crashed. So I've ranged this from August low and May high. You can see we've got a series of lower highs here. And so we're basically in an incredibly fixed range at the moment. That's the main range. We popped outside of it in August 5th. But we've been back inside it. We've kept inside that ever since. So on this one, if we go to the weekly chart again, let's take all this off. The bottom line is if we mark this. Well, for the moment, I'll just mark this most recent range, 8,035, 83.20. We've got huge amount of resistance up there at 8,300. 85 is the obvious resistance. So any sell into the high of this box play, this range, if we come into that range and then close lower and fall out, then this market is not gonna hold up. If it's a bull flag, then at the moment these lows are definitely definitely viable. Sorry. So any push back into 8,000 is still viable, but any close under 8,000, forget it. Start shorting. We'll look at this year's range. So we have the May highs. I'll tell you what, let's just go back to this most recent range. Yes, we're sitting on top of an ambush buy zone here at the moment. If we break 85, we're going to 88.50 and potentially 9,300 on the weekly chart. like I said, in a range-bound market like that, both buy the lows and sell the highs. So at the moment, any pullback to 8,000 or 8150 is buyable, but close underneath, get out and stay out. And one, potentially turn around, flip it and short. But for the moment, if this market can close above 83.25 this week, we could start to head for 85 and 100. FTSE is a slow market, so you need at the moment, I would suggest you wait and try and pick up a nice low number, at least 81, 8100, 8150, and then see if that holds and see if that can break that highs. So if you're holding UK stocks and US stocks at the moment, there is no reason to sell, but there is reason to be cautious, and I'll be looking at those three indicators to see where we are. So that's jobs, M2, and private debt. Okay, so let's have a quick look at a quick cross to the dollar. The dollar on this weekly chart is struggling up here. So the great last quarter from September right through to the end of the year, that's risen very, very nicely. This is a drop zone from November 22, but rise above this. At the moment, I would say this dollar is obviously very bullish, we're above all the averages. If we close above this 109, 110, then we're at least going back to the highs and possibly more. So watch out for that. Gold. Gold's been on a tear and really struggling. We had two gigantic weeks lower in November, pushed back in towards the end of November, and then we're struggling down here again. So what's my prediction for the gold? If we have a strong market with a strong dollar, I think this will roll over. So if gold can't get back above 27.25, then it's not going to make 3,000 anytime soon. I mean, all the time we're holding this average, and these lows down here are holding, 2,600 is holding, then we have got the potential to go to 2,300. I see what I've done here. I've put the range from October 23, and I actually put it up to 3,000 to see if it measures up for that move to 3,000. That's what I've done. So this is not fibbed to an existing range. It's fibbed to a futuristic potential range of 3,000 up here. So a higher close above 2650, and a subsequent close above 2720, and that could be going to 3,000. A lower close this week or a lower close anytime in January, where we close significantly under 2,600, this is toast, it's had it. For any market that can hold a 50-day average, keep buying dips, and this one can hold 50-day average. So gold looks all right. Oil, you know what? I think if oil crashes into this trend line resistance, I think this could plunge. We've got a very strong dollar. It's typical in a market like this to, if you've got a series of lower highs, every time we get a high, we sell. So we sell, 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 sell. This is obviously a decent support area, but if we knock our head into that trend line up there at about 75, 75.50, if we then subsequently close underneath here, I can see this coming down to 55. Certainly we're going to see 64. If 64 doesn't hold, we're going to see 55. So at the moment, these pullbacks are getting bought, but perhaps as we get into March, April, if or maybe sooner, possibly sooner, in the coming weeks, crashing to 75, can't hold, then this is done. Close above 75, then we're going to see 80, 83, and potentially 88 plus. But my best guess is we're going to crash into 75 and then drift lower, particularly if the market gives way. If the dollar maintains its strength and if the markets give way, then I don't think this oil's got a chance. Crossing to wheat, and then we'll look at stocks. The wheat cruised up there into late May and has had lower highs ever since. Long term, and I mean 1 to 3 years, I can see wheat really should really pulling up nicely. But the jury is definitely out right now. It's struggled most of last year, apart from that move in from March to May. Struggled the rest of the year, series lower highs. But I just think climate change, um, conflicts not resolved, and so on. I think this will at some stage pop up. It's just a question of when. My suggestion is keep buying dips. We might well see five. It would not surprise me at all. Mar Commodity markets, like anything else, love big round numbers. Here we are at $5, just under 5.50. Won't be at all surprised to see a test of $5. At that point, that might be a great time to get in. Quick look at some main stocks we were looking at last year. Pru had a terrible year. This is a weekly chart still. Can't close above the weekly 20-day average. If at some stage it closes above 650, then I think that's got the potential to do £7 or £8. In the meantime, that is a struggling stock. I'm in this one. Serious power. Volumes are picking up. A little bit of profit now at the moment. I think we can see that 350, 360 again. If it has a really good year, then I could see £4 or £5. The next target is 245, 250. Heck of a lot of resistance up there at 280. And again, we need to keep a very, very close eye on the stability of the market and those fundamentals, just to make sure. Why do I say that? Because this market's so high, because it's so rich. And I'm talking about the S&Ps here. The price earnings ratios are very high. And there is almost too much of a tilt towards the bull side, including the amount of margin that's being used. Oh, yeah, to prop up the S&Ps. Right. Advanced Medical Solutions is the jury's out on this one. All this support down here at 190, but if that gives way, we're going to see 164, 150 pretty quick. If that turns around and gets above £2, then expect that to go to 250, possibly £3 plus. At the moment, you can see all that support down there on this one, but I would not hang around if that doesn't hold that. Okay, good stocks, UK stocks last year were um, one. It's not on the list I've just picked up, so let's go and find it. We need to watch out for this in the future. We had a big blast up on the 26th of Feb, and that took it to 230 from 150. We broke 150 and then turn around. Here we are still climbing. So we need to watch out for these boomerang moves because they are, as you can see, very effective. Nice little higher close pin bar on that 18th November, just before that spiked up. Cousins, that was one of Andy's. Had a good couple of weeks back end of the year, but um, I like it. I mean, all the time it holds 80, it's got the potential to push up. But that's got a series of lower highs. So you definitely got to watch out for that one. Volume has been good in the run up to the end of 23, 24. So just keep an eye on that one. I do like Elementis. Any pullback to 130, I think it's a good one. That one, Monster. This one was a monster move in that weekly chart. Looks as if the dips are getting bought on that one. So that's dipped. That flew up to 55. We've recently seen 28. Wow. Well, let's go back to the daily. What a move. This started to build in September. Lovely pattern down there. Um, any stocks you want to look at, I'm going to go quite soon. So you might well see 30, 32 on that one. Otherwise, that just keeps marching up. Just flick through some of the ones we watched last year. Shell is building. I'm flipping across sectors at the moment. Vodafone. Had a good, I think this is viable. I think that 65, 67 is viable. Volumes have been doing, last Friday was very good. It's just pulling back into support at the moment. It has been a very slow, dodgy stock, selling, all the highs selling. But the volume suggests that is building down here in Vodafone. BT's had a good day. Ever since that moved to 131, it's been lows in buying. If you see 140, 145 again, that might well work. Where do I see it ending this year? It should go and find £2. Here's the latest move. Yeah, see, with this latest dip on 40 was key ratio support. But it should see 175, 180. And if it really gets running, then it can go back to £2. But it's a slug, it's a slow one. Take it easy. And let's look at this one, IQE. Speculative one. Gemring. Right, I'm going to leave it there. I'll do much more studies as the week unfolds, and then come back to you as the week unfolds and into next week. So good end to 24, good start so far to 25, 25. Let's see if the indicators hold up and the charts hold up to see if we can get pushing in through 20th of Jan when Trump steps in, and yeah, mainly to see where these first 2 weeks in January take us. All right, thanks so much for listening. Any questions, give me an email from tradeeasyway.com. Otherwise, see you soon. Thanks.